Good morning, everybody. This is RB, and I'm preparing for our weekend post and week prep for the weekly prep for the coming week, and just wanted to do the analysis here live, and record it to think about multiple things. One, we have data coming next week, CPI on Wednesday, and PPI on Tuesday. So one, I want to cover what a short-term action could look like. Between Monday, let's say a Monday session, what should we expect for that day before the PPI data comes early in the morning next day, and then we have CPI the day after, right? So I'm just going to try covering the bigger levels which should hold for the bulls, and of course if they don't hold, then what it looks like for bears, right? One, on a shorter time frame, like I said, for the early part of the week before the CPI data comes out, and then what should we expect in terms of levels from the CPI data as well? Should we be bullish? Should we be bearish? I'm gonna talk through those different levels which should hold and the chart structure that I'm looking at. So just going high level, just to repeat where we are so far. If you recall, we talked about, or you were pretty much accurate on, nailing the top at around 5260, 5280 range, right? And then we got tensions in Middle East. Then there was a sell after hours on a Thursday 2-3 weeks ago, where everyone went very bearish, but we knew that 4920 on US 500 is going to hold in after hours, and that's what happened. It held very well. From the next day, we started, becoming bullish, and with did long still be achieved 51.40. That was our level that if there is more sell to happen, it should come from here 51.40, or at the max it can go to 51.95, 5200 range. So those were our estimated numbers that if the sell has to come back and go to 4800, then that's where the reversal should have happened. Right now, it has gone a bit beyond my expected levels, but does that mean that it cannot reverse? It can. I mean, we have talked about it. We have talked about the flat structure that it could be forming, where if this was an A wave, and you know that the corrective waves are A, B, C, right? So if I call this incompleteness an A wave and we are in B, in flat waves, the B can retrace up to 90% or 100%, and even sometime go above that before coming down for the another leg, right? So corrections are corrections. I mean, we know that when there is a motive wave, going in one direction, we know there are five waves, right? We know the structure that is forming, so it's pretty easy to trade on the directions. But when it comes to corrections, corrections have so many formations. You talk about flats, you talk about zigzag, you talk about triangles. You have a combination of them, which is called complex, right? So it's very hard to say that, oh yeah, it's gonna go up because it's an impulse, right? And it's not. I mean, we are in a corrective structure, so we'll have to be very careful with our levels, and unless there is a change in those, you cannot flip from bullish to bearish and all that kind of stuff, right? So you have to think both sides all the time when you're in a correction, because if you want to just go long here, hey, we are above 5200, so it's long, right? So yeah, let's just keep going long. No, that's not how it's going to be, because if it's flat wave, the sell is going to be so sharp here, you won't even get a chance to exit from your longs, and it'll be a total loss, right? So that's where becoming cautious when you are retracing a drop becomes very important, because think about it. I mean, here you're thinking about capturing a long where there is this high where the liquidity resides. You are trying to capture a long, let's say from 5200 to 5280, which is 60 points, but down below you have about 400 points drop. So the risk reward isn't really there in longs when you're up high and when you had a big drop which made the new lows or the lower lows, right? There is always a chance of making a lower high or a double top and then selling down, right? So that's why corrections are complex, and we always have to go with the levels to make sure that if this is a formation of the new impulse pattern, then the bare minimum levels that we are going to talk about should hold, right? So that's an expectation. And if this is a new impulse, let's say it's not a corrective a wave where we'll have a third sell down, then the opportunity is tremendous, because what you're looking at right now, let's say potentially gets to the double top and make a five-wave structure, it's going to come down again. It's going to come down back to this demand zone we have talked about, 50-70, before it starts making any new highs, right? So there will always be an opportunity. Now the question is that whether you want to capture this remaining portion of the move as a long. Yeah, probably you can scalp it, right? But the point I'm trying to make is that if it's established that it's a new wave, right? Yeah. So what you have to wait for if you're a patient trader is that it comes back to this demand zone, and then you go long here for a wave three up, because that's going to be a very good risk reward where that your stop losses are here at 5,000, but you're looking at a move to 5,600, right? So the whole story shifts, where before you are trying to go long here for 60 points, but you have a downside of 400 points. But now here, when you go long here, you have a downside of 60 points, but an upside of 500 points, right? So that's how you need to think as a trader, that do you want to, chase the long near to the tops, or do you want to first confirm what structure is you're in, and then you retrace, wait for the retracement at the demand, and then you go long, right? So risk reward is all what is important in the trading, and that's how we think, that's how we trade. Scalps are different. You can always put in some lot of money in there just for scalping few points. But if you are swinging something long in terms of stocks or ETFs or even long dated calls or puts, you have to figure out the places where you're more confident that, okay, yeah, this makes sense. If I lose, I lose, or I slowly build up my position, but my risk reward is pretty high, right? So that's an overall thinking that a trader should have when looking for the trades, right? And now, since you kind of understand what where I'm going with this, I mean, I kind of shared two structures, right? So whether we are making this as a 1, 2, 3, 4, 5, that's one way of looking at it, right? And the other one that I told you was that we are in a flat structure. So either this reversal candle that we got, this is it, and next week we are gonna start breaking the levels, and we are going back into where we talked about 48.13 and 48.16, somewhere around that, as a flat wave, right? So these are the two paths that we have to keep in mind on a larger time frame basis, right? So if let's say PPI or CPI comes in hot, and by Wednesday morning after that comes, if we are trading below 5,100, yes, then the red path is kind of a confirmation on that any bounce that comes after that should be shorted. Okay, so that's a confirmation for that. And why it's a confirmation? Because because with that data we are trading below this small demand that we have, which is created after rallying here, basing, and then rallying again, right? So if this demand is broken, which is between 51.95 or 51.92 and 51.62, if this demand breaks, then we get to the next demand level. But then you can see that it's not an impulse wave anymore, right? Because this drop is too big, and we are now in the territory of the first wave, right? And there will be a bounce because this demand zone exists there, but that's going to be a bounce for like a wave two up for this, and then a wave three down, and wave four or five, right? So that kind of tells you that as long as you are, or the SPX is above this particular zone, things stays bullish. And Yeah, so things stays bullish, right? So in the previous video, I also talked about that 5195, 5200, or 5190. I mean, these are the levels which needs to be hold, and any shorts that needs to be done should be below that. Now you can short the break of 5190, but I would recommend that again, I mean, depends on the sizing and the risk and the uh, you know um, appetite that you had for that. But if I would be looking for a swing, I would want this shift to happen, a shift of structure to happen, where this previous low of 5160 is broken. I've created a lower low. There is a break of structure. It moves back up, retraces, goes back into the previous demand, which is now a new resistance level or supply levels, and then we go short for the next leg down, right? So that's one way of trading. But like I said, if you want to take a short, the short is below 5190. Will it bounce again from 5160? Can it be something like this? It's possible. That's where I want this demand to be broken completely, right? So that you are very sure of of the trade, and that the direction, right? So that's the larger time frame structure now, right? So now let's look for a little shorter time frame here and see what's going on. We'll keep those two models up as is. Now just from let's go a little more lower into 2 hours probably. Let's do this, right? Okay. So we talked about this level, right? This zone 5190 and 5163. So very important zone, as I explained before. And let's talk from the bull standpoint first, right? So what had happened last week? If I just see a small action here, that this was wave one, wave two, wave three, kind of making a wave four here. For the bulls, a wave five may come on Monday, right? So I would say as long as 5200 or 5202 at that level is holding, there is a chance that we go first up towards this white path. Let me just color it white again, right? And yeah, and test or get close to the higher levels of 5250, 5260, somewhere there. Yeah, 5250, 5260 makes sense, right? And then for the next 2 days of data, we potentially come down, right? So we do this zigzag wave down, or whichever format, if a wave 4 correction happens, we come back down again, test this zone, right? The critical zone that I marked. Let's just make it a demand zone so that you remember, right? Monday we go up after bouncing from the lower 5200 range. We bounce up. I don't know if there will be a 50-point rally on a Monday, or will it be a PPI pump and a dump, or however it plays out. But I'm looking at one more high for bulls to get to 5260 range, and then for the next couple of days, we sell back and test this demand level. So we should come back to this demand level regardless. When it happens after PPI, CPI, I don't know. We'll just continue to monitor as it moves, right? And this is a bull's case. This is the white case that I'm talking about right now. And once it hits the demand level here in 5190 area, we expect the last wave five, which will break this double top and make a new high at around 5300 or above, right? So that's gonna be my count here for. For the bulls, right? So yeah, and this can come a little lower. Can it go higher than 50 to 60? Maybe, but looking at how the divergence is forming in the lower time frames, my thinking is that the wave three is sort of in the um, in the very last wave, where this would be like a wave five of three, basically, right? So if I'm looking at the overall count here, so it's like 1, 2, 3, 4, and we are doing a 5. And if this was like the 4, then this is 1, 2, 3, 4, 5, right? So a 5 of a 5 of a 3, right? So it looks like that, that should end somewhere in this area below the previous high. Makes sense. The double top rejection, there would be some sellers sitting out here in the same levels to short it, right? And we come back to the demand level, and this demand level, like I said, is very important. This is going to be tested one way or the other, and if this holds this 30-point area between 60 and the 90, we are going to get a bounce which is going to take it above 5300, right, for the fifth wave. And then again, once this 5 waves is done, we are going to come back down again. It's not that we're just going to keep flying, right? We are going to come back and test somewhere around that 5070 area or 5100 area, this area somewhere, which we said before, right? So this is our bulls case where we have some steam lift, and then we sell back down. So that's for bulls. But now let's just remove this, and let's talk about the bearish case, right? So the bearish case suggests that, okay, now can there be one more high? Probably, that's fine. There's no problem, but the count is not the 1, 2, 3, 4, 5. Then we are looking at this being an ABC, right? So that we had a one A leg, a B leg, and this is the end of the C leg, right? So even if it makes a new high, let's say on a Monday, somewhere around 50 to 50, 60 range, like I said before, just to complete this move, that's fine. And what we're looking at is for PPI or CPI to actually, make a big sell here. When we say big sell, it's more than 100 points, right? So if we are trading at around 50 to 50, 50 to 60, we are looking at any one of those data points to break this 5190 and 5160 as well and give us a big drop, right? This is maybe a multi-day sale, right? That's what is needed to break this structure. Come down from 50 to 40 to 5100, 5090 range, right, and make this as wave one. This is big. And does it happen in like one shot? No. Of course, it's gonna be 5 waves as well, right? So where this happens, we bounce, come down again, and we make this 5 waves, right? So but you have to be careful. If you get this sale, don't just get confused. Oh yeah, we are still in the demand range, and go along here that we are going to have a new high. You'll have to kind of see what kind of sell this was it a choppy sell or an impulse sell? Because if you remember in the previous one, I said it's going to make these bounces, sell, come to this demand, and then just go up, right? But if this is a very sharp sell hitting the lower level here, and it's just bouncing because it's a demand. And remember that whenever you are in a counter trend correction, every demand is tested, and there is a bounce in every demand, and that's where it make it very complex to short during the corrections, because demand bounces, right? And your stop losses will get hit pretty quickly because of those sharp bounces, because there are order blocks, there are orders sitting in there which gets executed, right? So coming down, like I said, if you get a sharp move down in a matter of, let's say, by end of week, you are at 5090, you pretty much know that, okay, the trend has changed again. We got supported here at 1590, which is this trend support, and now another bounce will come because this again is a big demand zone. There is this trend support. Yeah, okay, let's just bounce, right? Give new hope to bulls that, okay, maybe this is now leading diagonal in the formation, right? So again, many formations for everybody. So 1, 2, 3, 4, 5. But nah, my thinking would be, yeah, it's a dead cat bounce. Of course, we are bouncing from the demand, and we are going for a second wave up. Will I long it? Yeah, of course I can long it, because it's again another 160 points bounce or something like that, right? Definitely long it, scalp it, and see what happens again when you reach into this particular area, which again probably would be 60%. Yeah, so around 60% here, or maybe 50% here, right? and then see how it looks, how the structure looks. If you find this as a bear flag, you can always short the break of the bear flag, right? So if this becomes a flaggish kind of structure, you don't always have to short here, because you would have seen that whenever you mark a flag, sometimes things start slowly, like the bull waves starts very slowly, but all of a sudden this flag, instead of rejecting, it starts going up, because yeah, it's um, start of the impulse wave, where the small wave one would be a leading diagonal or something like that, and of course wave three catches a fire, right? So the safest way to trade this is that you probably, like I said, you can short, but you'll have to have a stop loss very tight above like 51.90 or so, or 30 points, that if this keeps going up, or your bear flag starts to break upwards, you should simply get out, right? But the best way to short is to short the another break of structure, because when this bear flag breaks, you know that a new lower low is coming, right? You made a lower high, now a new lower is coming, and that's potentially your wave three down, which is a good long wave to capture, right? There are a lot of points here to capture, right? So that's gonna be my bearish view, right? So like I said, in simple terms, as long as 51.60, 51.90, this range is holding, path is up to make a new high. But if this is gone in this week, in this coming week, and we are testing 15.90, then we are back into short the rep mode, right? So that's about it. I know it's a little long video. I hope you are able to understand where my thoughts are, and it helps you, formulate your plans of how you want to trade next week. Well, thank you very much, and please like and subscribe, and have a good rest of your day. Thank you. Bye bye.